If you followed along our value investing channel all this time, or if you're new, we've said no to a lot of companies over the past 3 years. It's been lots of no's. We get criticized. Recently, Paul, we've switched our stance on Alibaba. We were buying in the 200s at 190, and now some of our followers who unfortunately tried to mimic your take on Baba, Paul, in the end, we're trying to teach a process, but we are still excited about dollar cost averaging in to Alibaba. We like the numbers. We think it's a definite value play. And Paul, for new subscribers, new investors out there, including myself, Paul, I had some confusion about the idea of I'm going to buy a value stock today and be happy about it going down. I said, well, obviously we just wanted to go up, but you sort of educated me on timing the market, dollar cost averaging. What do these terms mean if you're new or if you're somewhat seasoned, Paul? I mean, I've been doing this a while. I thought I had a grasp on it.
You're seasoned, baby.
And I'm still a little confused. So coddle me through the idea of what dollar cost averaging is and why you're still thrilled with Alibaba falling.
So first, we criticize a lot of the YouTube hypers.
Yes.
Actually, first,
Of course, Paul.
you need to follow me on Instagram because
One of the viewers said, "Dear God, well, can Paul just please get the check so we can move on?" The blue check. And yes,
I need a blue check, guys. Please follow me on Instagram.
Go ahead.
So when we criticize the hypers when the stocks go down, here's why we criticize them. They have no reason to believe the stock. They have no legitimate reason to believe the stock's going up. There's no process to it. For us, if we believe the numbers and believe what's going to happen in the future, you should want the stock price to go down so you can get more shares at lower prices.
Now, this is confusing for some new people, Paul, because
Well, if you're a hype person, you can only make money if the stock goes up.
that's true.
But if you're a value person, you realize over the long run, the stocks, if you buy 20 or 30 stocks with the same process, they will go up over time above average. So the more it goes down, the more shares you can buy at a cheaper price. And that's called dollar cost averaging. What we're doing there is you're buying the first round of shares at, for example, I bought Alibaba at 184. Okay? Then I bought it at 180. Then 175. Now it's at 158. I'm buying more shares. So as it goes down, my average price is going down because I'm picking up more. If I buy one share each time, my average is around 170.
Yes.
172, whatever the number is. So instead of buying at 184, I'm buying on the way down. The same thing as when we tell people, when you buy your investments and buy your ETF, buy every single month the same amount. Sometimes you'll overpay, sometimes you'll underpay. Except in Alibaba's situation, when you understand value versus only understanding hype and only understanding that stocks should go up, we are buying the same price shares we think in the future at a lower price. Because over a long period of time, a stock's price will pretty much follow, like in Richer, Wiser, Happier.
Yes.
A stock's price will follow earnings. As earnings go up, it's just like this. If there are two companies here, one that makes $10 a year, one makes $1 a year, which one would you rather pay for? They're the exact same company, exact same industry, everything. Which one would you pay more for?
The one that makes more money.
Exactly. So if this one goes to, let's say, 100, and this goes to 10, which one grew more?
The same. They grew
the same. They both grew 10 times. But what you see people make the mistake of, the stock price should go up the exact same amount. But people sit there and go, oh, 100 is more than 10, therefore I'll pay more for this. No, you should pay the same amount of money.
Oh my gosh.
That's the same amount of money.
It just, yeah.
Because the growth is the same.
That top one sounds more thrilling and amazing.
Oh, yeah. But they're dumb. Or some other people will see 10 versus 1 and say, oh, well, 1 can grow faster than 10. Makes sense. But if they're the exact same kind of industry, exact same company, when I say that, means same revenue, same everything, except the profit's different, why would you pay more for this one? And that's the problem with investing. So on the value front, we're teaching that, hey, if you analyze a company and you really believe the future is going to be X, then you should buy as many shares as you can as it's going down.
Yeah, let me bring this back home, Paul. Is that you and I got in a spicy conversation because I invested in Alibaba. The people I really like, Manish Pabrai, Sven, they're all doing videos on Baba. I trust you. I'm not trying to clone what you're doing, but I mean, I like it. And then it went down, and it was funny. You said to me, as a value investor, you want the stock to go down. Do you want the stock to go down? I said, no, I want the stock to go up. And then like, well, wait a minute. You got me all spun around the idea. And then you said, well, if you can't understand that you want the stock to go down that you love, you shouldn't have been in it to begin with.
And that's what I said to you. How bluntly did I say it to you?
And that made a lot of sense. And let Paul explain to you viewers at home what he means by this. Like, I got in at 190. Now that it's 155, a normal person or your spouse, someone less experienced, would say, I'm freaking out. Why did I buy a company that's now losing money? But what should be my thought process?
So this should be your thought process. And this is the hard part about investing. This is what makes investing hard. If a stock is selling for 100 today, the Lord Jesus Christ, your Savior, comes down and says, Paul, in 7 years, the stock will be 500. Would you be happy?
Sure, that'd be great.
Great. But right now, the stock's at 100. Tomorrow it goes to 90. Are you mad?
Well, if I'm new.
Jesus Christ came and told you it's going to be $500.
Did he?
He came in here and said, it'll be $500 in 7 years.
That's true.
Okay, let's say it goes to 80. Are you going to be mad?
I mean, initially, yes.
Why would you be mad? Tim's shaking his head. He's right. Why would you be mad? Jesus Christ came here and said, forget the kids in Africa who are dying. You're going to be rich. You're going to be rich.
Okay.
Why do you care if it goes to 80? What if it goes to 70?
I have to explain to my wife why I bought a stock that's
Now,
going down.
That's the hard part about investing, because we don't have Jesus coming to us and telling us it's going to be worth $500.
But aren't you a close second? You're Iraqi.
I appreciate that. It's a very divisive reference, but Jesus would have more than 2,850 Instagram followers, unlike I. So see how I did that right there? So here's the point, though.
Have a Patreon with 5,300 people.
I know, you're right.
I mean,
he wishes. But here's the deal. The goal is you buy a package of 20 or 30 stocks that over a long period of time, you can sit there and say, I think I know. I'm going to be wrong on some, I'm going to be really right on, I'm going to be wrong on a couple. Some are going to be wrong to the downside, some are going to be wrong because, Paul, you didn't realize they were going to go faster than that.
Yeah.
And most of them are going to fall somewhere in the middle. But as a package, you're going to be able to say, as a package, these 30 companies are probably going to do better in the next 7 years than worse. Mm-hmm. So if they're going to do better financially, if all 30 companies grow their profit and you paid a reasonable price for them today, the companies will be worth more in 7 years.
And I brought this up. It's like we've done so many videos. I started the video by saying how many no's we have, Paul. But in essence, you're right. If I was in love with a company, Baba, at 200, as hard as it is to explain to my wife.
Well, you shouldn't have bought your full amount at 200.
Oh, really?
I always said, I start a position. I start my initial position, 184. I probably buy 1/10 of what I want to own of the stock. And as it goes down, I buy more.
I'm chuckling because my 11-year-old son.
Tell me he told you that.
He remembered it from you.
Thank you.
And
Gio.
I didn't.
Can you tell your 11-year-old son that he's the new host of the show? Because at least he listens to me.
I mean, I got, this is the mindset that I'm trying to learn, and probably our viewers are too. I got so excited about a final buy.
And Gio's a lot more impressionable because he's young. He's going to listen to a lot more things. You have 40 years of listening to something that didn't make sense. It doesn't make sense. Why am I buying something that goes down?
Yes.
Well, I ask you, when your favorite store, your favorite clothing store has a massive 50% off sale, do you go, oh, gross, I'm not going there?
Yes.
No. Of course you go there. You can buy as much as you can. Wow, this is amazing.
Right.
Same thing with a stock.
I see.
But it's very hard every single day seeing that stock price go down and down. And it says your network, just like housing. I bought a lot of houses in 09 and 10. And I was buying houses week to week to week that were going down like, oh, I could buy this house before for $20,000, I could buy it for $15,000. But I never thought to myself, shoot, that means my one I bought for $20,000 last week is worth less. I never thought that. Why? Because the house doesn't have a big number on top of it saying, this is what this thing is worth today. And it keeps going down and down and down. All I thought to myself is I'm buying a cash flow. Just like if your neighbor came to you and said, this is the analogy I'm pulling. Hey, I have a mechanic shop. It's made new profit, record profit every single year, and the future looks great, but I want to expand it. Would you invest? You'd be like, cool. And then if you invested and he hit his numbers, or her numbers, sorry, 7 years later and profits kept going up, your mechanic shop is probably worth a lot more money 7 years from now today.
Seems right.
The issue we have is stocks are in our face every second of every day. Mm-hmm. We can log into our account and see it every single day.
Oh, Robinhood texts you. It's like a game. It's like social media.
We should change our app that from now on, when you have a value play, you can tag it where it says, congratulations, your stock price is now lower, go buy some more. We should do that.
Yeah.
Because we should congratulate people that you do the right homework. Now, the hard part about investing, though, is that we don't know what the future is going to hold. That's why we pick 20 or 30 stocks and we're conservative about it. Now, one thing I want to talk about here, Seth, the two most important metrics here say that Alibaba is expensive, and yet I don't care. So for those of you who say, oh, Paul only cares about the numbers, I do. I care about the growth numbers. The growth numbers make these multiples well worth paying. Why? Let's go to our stock analyzer tool, Seth. I already put these numbers in.
Yeah,
I'm doing a 7-year analysis here.
Oh, go for it.
The company in the last 5 years has done 44.5% revenue growth. I went low and did 15, 20, and 25%. I assume they increased the number of shares by 1% per year and kept it the same in the high level. Margin, I went lower margin. I went lower free cash flow. I went lower multiple. Look at these multiples of earnings and free cash flow.
Conservative.
Very conservative. And I did low percentage of returns. Now, we hit the analyze button.
The price is 158, Paul.
The price is currently 158. The price is 158, and look at this, guys. It tells me on my middle assumptions, I should be paying 263. It's almost at its low assumptions here, Seth.
If you buy under 263 today, you can expect a return of 12.5%.
So if you're buying at 158, what kind of return are you getting?
Look at that, between 12.5 and 15.
Yeah. And I believe that Alibaba, as long as the concern I had about Alibaba before was China. I didn't trust the numbers coming out of China. However, I did one form of cloning. I cloned Charlie Munger's analysis of China. And he said, I'm comfortable with this. I am buying. So I said, if it's good enough for Charlie, it's good enough for me. I have no idea what Charlie values the company at. Frankly, I don't care. I did my own valuation, but I did trust his analysis of China and Alibaba's numbers. Okay? I do believe in that. I don't believe in cloning just to buy something because somebody said this is a good. I didn't buy Alibaba because I thought it was a good price. I bought Alibaba because I didn't buy it, because Charlie Munger said it was a good price. I bought it because I always said, if you look at our past Alibaba videos, if you believe the numbers, this is a good buy. Right? So I'm sitting there saying, this is where I stand. Now, one thing I do want to show you that we're adding into the stock analyzer tool, which is awesome. It's going to tell you the future 7-year value of each of these assumptions here, right? So it can tell you what the stock could be worth. So while Seth explains some other things about Alibaba, what we're trying to do here for our software and things like that, I'm going to actually show the numbers based on our middle assumption where I think Alibaba stock could go to by taking the revenue out to year 7, taking the number of shares outstanding and dividing it by it, and then also applying the PE and tell you I think the stock is worth X in 7 years.
If you're interested in the software that's behind Paul, you can join our Patreon and get this software. We will be moving off Patreon most likely in the next few months, if not month, and we'll be saving you on some fees. Patreon has some crazy charging fees, and you can have access to the software if you're investing out there, frankly, by yourself and only looking at ticker prices. I did that for a long time, but if you want to up your game, you can join our Patreon, get access to all this data and see the numbers behind these companies and join our community of 5,300 patrons all over the world talking about Baba on a daily basis. You get videos from Mo every day. You get updates of our portfolios, what we're holding, and it's an incredible community that's been growing. One of the greatest patrons on the planet, Paul. We went from zero to having one of the best patrons out there, and with your support. So if you want the software, click the link below and you can grab it. And Paul, you're doing some bonkers math over there. What do you do?
So what I did basically was I took the revenue today of 118 billion.
Yeah.
And I increased it by our middle assumption, which was 20% a year for 7 years. Took us to $422 billion in revenue. I took a 19% profit margin, which is about 80 billion in profit. Then I put shares outstanding increasing about 0.5% per year, which is 3.5%. Takes our shares outstanding to roughly 2.82 billion. So divided 80 billion in profit, divided by 2.82 billion in shares, and that gives me a number of $28.40 per share in profit. Then you multiply that by your PE. A PE of 15 makes the stock 425 in 7 years.
It's currently 158.
So it's almost a 3-bagger in 7 years by buying a very good company that I think is underpriced, right? So that's where you get your 12.5% return from. If you paid 158 and you got it at 425 in 7 years, you made it about 12.5% of your money. If you do this on 30 companies, you're going to do quite well in life.
And let me bring it on home for you new folks out there. There are companies that are very, very overhyped right now. The stock price is through the roof. However, the numbers, their financials, their growth is not so much matching it. They're talking about future predictions, what they're going to do 10 years from now. This is a unique value investing position where we have a company that's growing exponentially and the ticker price is going down. That's why we like it so much. This is value investing in a nutshell, right, Paul?
Yep, and I hope to find at some point in the future, and I know I will, 28, 29 other, well, I already have other ones, but I hope to find 25 or 30 other Alibaba type companies that when the market perceives their value to be a lot worse, I can pick up shares.
That's our take. Follow, thumbs up, join the Patreon. See you next video.